Hi, I'm Jennifer Nicely with Pinnacle Real Estate Academy. Today's video is about the notification you most likely got in the mail from the tax assessor's office. What does this mean for you? What does it mean for your clients? See, by law, the government is allowed to reassess your property once every 5 years, and we are at that 5-year mark. Now, most of you got notification about a change in your taxes, and you probably don't realize exactly what that means and what you need to do, so I'm here to talk with you about it. Now, at the very top of this form, it says this is not a tax bill. It's just a notification. Very, very few of you, if anyone, did not receive this document. And the reason why the majority of you did is because the values have increased so greatly over the last 5 years. Now, if there is a tax assessed value of more than $1,000, it is required by law that they give you this notification. That does not mean your taxes have increased more than $1,000. It means your tax assessed value has increased more than $1,000. So you're going to see two numbers there. You're going to see an appraised number and you're going to see a tax assessed number. What does this mean? These are two forms of the formula to calculate your annual taxes. So your tax appraised value is what the tax office says your home is worth. Now, ideally, you want this less than market value. So if that number comes back and you go, no, my house is worth more than that, shh, don't say anything. You want to keep it less than market value. If that appraised value on that document says it's more than what market value says, then you're going to want to go defend it and get that price down. So what does this mean? You take the tax appraised value and you're going to multiply it by either 4% or 6%. 4% rate is only for primary residence. Only primary. So if this is your solely primary, your driver's license is there, your voting card is there, everything is there, then you get taxed at the 4% rate. If it is your secondary, your vacation, it's an investment, literally almost anything but primary, you're going to multiply that number by 6%. So let's say that I have a $200,000 appraised value property, and it's my primary residence. I'm going to take $200,000 and I'm going to multiply it by 4%. And that is going to give me a tax assessed value of $8,000. Now, what does $8,000 mean? Really nothing. It's a stepping stone in the formula. So when you see on that document tax assessed value and maybe it says $30,000, $23,000, please don't panic. That really doesn't mean anything other than it's a stepping stone in the formula. So now we're going to take that tax assessed value and we're going to multiply it by the millage rate. Now, I cannot give you that millage rate because there's multiple millage rates all over the state. So your city, your local city may have 4 different primary millage rates and 4 different secondary millage rates. So you would need to call the tax assessor's office and say, here's my address. What is the millage rate for my property? So let's go back to our example. We said the appraised value was $200,000 and it was our primary residence, so that was 4%. So we're going to multiply the $200,000 by the 4%, which gave us an $8,000 tax assessed value. Now we're going to take that $8,000 and our next step is we're going to multiply it by the millage rate. The millage rate is always going to be 3 digits, 3 decimal places. Now, it could be more, but a minimum of 3 decimal places. Your millage rate may be 0.097. It could be 0.198. It's all over the board. So once you multiply that tax assessed value by the millage rate, that number is going to give you your annual taxes. So that is how you're going to calculate how much your taxes are going to go up or go down. The majority of you probably have your taxes escrowed in your mortgage, which means that number you just arrived at would be divided by 12 And that is going to be the change in your mortgage payment come January of next year. So I'll go through that formula again. We're going to take your tax appraised value, multiply it by the tax rate. It's either going to be 4 or 6%. That number is going to give you a tax assessed value. Then you're going to take your tax assessed value, multiply it by your millage rate, and that is going to give you your annual taxes. If you're escrowed in your mortgage, you divide that by 12 to get your monthly payment. If you're not escrowed in mortgage, that's your new annual tax payment. Now, what does all of this mean? Let's say that they came back with an appraised value that is higher than market value and you go, absolutely not, that's crazy, my taxes should not go up this much. You have until October 1st to defend lowering that appraised value. So if you are questioning whether or not the tax appraised value is correct, please call your realtor, please call your real estate agent, have them run some numbers for you, see if that's accurate or if it's something you may need to defend. If you are a real estate agent or a realtor listening to this, call your clients. This is one of those touch moments that you can have when it comes to marketing to stay in front of them. Another thing that we do as real estate agents is not just close on your home, but take care of you in the future too. So utilize this time to maybe send out messages to all of your past clients. Hey, I know you got this letter. This is what it says. This is what it means. Call me if you have questions. I'll walk you through it. If we need to call the tax assessor's office, I can give you those comparable properties to defend why your property isn't worth what they're saying it's worth. As always, if you have any questions, give us a call here at Pinnacle Real Estate Academy. Comment in the video below. We're always here to help.